Imagine someone demanding your plastic payment card right this second. It might surprise you to realize that handing it over gives a fraudster an open door to your actual savings, rather than a line of credit or a temporary hold. We are talking about the genuine cash balance where your monthly federal retirement benefits arrive. Too many people discover this devastating reality only after it happens because they falsely assumed their financial institution would shield them completely. Your local branch does maintain security measures, but what they fail to explain is that these protocols do not block the initial theft. The cash vanishes instantly, and only afterward does the bank open a file to figure out what happened. While their team reviews the details, your real-life financial obligations, like your house payment, electricity costs, insurance policies, and critical medications, continue to come due. Today, it is vital to look closely at the precise reasons why this specific type of fraud inflicts such severe damage on retired individuals, the obscure federal mandate that leaves you vulnerable, and a straightforward way to arrange your finances so an active thief can never touch your core livelihood. Before going any further, it is vital to dismantle 3 widespread misconceptions that lead folks to believe they are completely safe from this danger. Embracing these falsehoods can become incredibly expensive. The first mistake is believing that monitoring your financial statements frequently will catch the problem early enough. In reality, you will only be observing the damage after the fact because the funds disappear the exact moment a charge goes through. For instance, a hidden skimming device placed on a fuel pump you utilized 3 weeks in the past could trigger a fraudulent $2,400 extraction at 3 a.m. right when your mortgage is set to process. Your first notice of the issue will likely arrive at 9 a.m. when your mortgage holder calls because your payment was rejected. The second incorrect belief is that your institution's fraud coverage guarantees your protection. While protection exists, banks are under no legal obligation to replace your missing money while they evaluate your claim. They conduct the review first while your balances remain empty. Under existing federal guidelines, this institutional review can drag on for 10 business days, expanding to 45 days if the theft involves overseas entities. Your monthly expenses simply cannot wait over a week for a resolution. The third common mistake is assuming this threat only targets people who buy things on the internet, leading you to feel secure using your card face-to-face at familiar shops. Recent figures from FICO's 2025 data reveal that over 243,000 debit cards fell victim to skimming devices in that single year, representing a 5% surge compared to the prior 12 months. Skimming requires physical contact by its very nature, occurring at everyday locations like fueling stations, automated teller machines, or local dining spots where a worker takes your card away for 45 seconds to swipe it out of view. Your purchase appears entirely legitimate and you complete the signature, but your data has already been duplicated before you even leave the table. Later on, we will explore a basic arrangement involving 2 distinct accounts that money management experts utilize to guarantee a criminal can never access their primary revenue. Implementing this setup requires nothing more than a single phone conversation, which is worth keeping in mind because every risk discussed here has an uncomplicated solution that works every single time. You might wonder why financial institutions never bring this up during your routine visits. The truth is that banks pocket a transaction fee from business owners every single time you utilize your card. Higher usage directly translates to increased profits for them. Consequently, the local branch manager who has greeted you warmly for 15 years lacks any financial motivation to pull you aside and explain that the specific card in your pocket offers the flimsiest security and the highest likelihood of clearing out your checking balance. Having that conversation would actively diminish their corporate earnings, so it stays unsaid due to institutional incentives rather than a hidden plot. Compounding the issue, Congress decided in 2026 to strike down regulations that were designed to limit individual overdraft penalties to a maximum of $5. As a direct result of these types of penalties, everyday citizens surrendered more than $12 billion in overdraft and returned check fees throughout 2025. The very corporations pocketing those billions are the identical entities profiting from your daily card transactions. There is a fundamental contrast between your spending card and a traditional credit card that your financial institution will avoid putting down in black and white. When you use the former, your money departs your possession the very instant a criminal strikes. If you detect the theft rapidly and file a report within 2 days, your personal financial liability maxes out at $50. However, if you let more than 60 days pass before reporting it, you run the risk of losing every single dollar the thief managed to extract. The institution has no legal mandate to replace any funds beyond the strict statutory minimums, and throughout an investigation that often lasts 10 business days or even longer, your balance remains completely depleted. On the flip side, a fraudulent transaction on a credit card never actually leaves your pool of wealth. Instead, it merely rests on your statement as a contested transaction, meaning you do not owe a penny toward it while the corporate investigators do their job. Every major credit provider across the nation will wipe out the unauthorized charge immediately upon notification, ensuring you never lose your grip on your funds. It comes down to 2 items sitting in the same wallet, where one pulls your actual money before anyone verifies the facts, and the other leaves your cash alone. This is the crucial distinction your local branch fails to highlight. Consider a situation that repeats itself thousands of times every single month all over America. A 67-year-old retired woman receives her monthly Social Security benefit on the 3rd of the month, totaling exactly $2,071. She proceeds to use her card for everyday necessities like fuel, food, and a handful of digital recurring bills. On the evening of the 4th, an online thief uses her financial details, harvested from a pump skimmer she encountered a fortnight prior, to execute 4 distinct transactions that siphoned off $1,620 at brick-and-mortar retailers located in a completely different state. Upon checking her smartphone on the morning of the 5th, her available balance has plummeted to a mere $451. She contacts her institution immediately to declare the unauthorized activity, prompting them to launch an official review. By federal mandate, the bank is granted up to 10 business days before they are required to provide a temporary credit to her balance. While some companies act swiftly, plenty of others choose to wait until the entire matter is settled before returning a dime. In the interim, her scheduled housing payment of $890 hits the account on the 10th and is rejected. Her $140 utility charge processes on the 12th and fails. Her additional insurance obligation of $210 attempts to clear on the 15th and is turned away. Every single one of these bounced payments triggers an immediate penalty. At the prominent national institutions most older Americans patronize, these individual fees hover between $34 to $35 per occurrence, and the companies trying to collect the funds frequently tack on their own returned payment penalties as well. By the time the bank finishes its investigation and replenishes her cash, she has amassed $15 in penalties from her bank, another $75 in fees from her service providers, a negative mark on her insurance record, and has spent 12 days speaking with various billing departments to fix a mess she did not cause and was never warned about. The theft itself paled in comparison to the domino effect of failing financial systems that followed, all sparked by tying a single card directly to her primary source of income. Some folks might view this and assume it does not hit home because they possess an extra cushion of a few $1,000s put away. If that applies to you, please listen closely for the next 5 minutes, because this preventative approach is not merely for individuals hovering near empty. It is designed for anyone who refuses to let an out-of-state thief dictate when their life gets disrupted. The method is known as account separation, and professionals inside the financial sector have quietly applied it to their own personal wealth for decades, while issuing standard debit cards to the general public. The execution is simple. You preserve a single account as your master vault where all of your income arrives, including your Social Security deposits, pension allocations, and investment gains. You never share this specific account information with merchants, and you never use a card tied to it at fuel pumps, supermarkets, eateries, or anywhere else a card terminal might be altered. This account holds your livelihood and remains shielded from the public eye. Next, you establish a secondary account dedicated purely to daily outlays, complete with its own debit card and a minimal balance that you replenish as needed from your master vault. For example, you might place $300 into it every Monday to handle routine expenses. If a thief happens to intercept that card data, they can only grasp whatever remains of that small balance, meaning $300 or less, rather than your $2,071 benefit check, your total monthly revenue, or the account tied to your automatic household bills. An even stronger alternative to a secondary spending card is transitioning entirely to a credit card for daily usage, not for the purpose of carrying debt or paying interest charges, but simply to use for all transactions and clear it out completely when the statement arrives. Operating this way ensures every single purchase is shielded under the umbrella of the Fair Credit Billing Act, giving you zero financial liability and immediate reversals if an issue arises, while the checking account handling your mortgage, utilities, and insurance stays completely isolated from public merchant points. If you prefer to steer clear of credit cards to avoid the risk of overspending, the two-account method utilizing debit cards achieves the exact same protection. The underlying concept remains identical. Build an absolute barrier between the place where your income rests and the card you show to the world. A thief who compromises your secondary card walks away with $300 and a worthless piece of data, whereas a thief who hits your main account steals your housing money, your power bill funds, and your healthcare cash. Let us also clear up another vital point right now. Many people assume they are safe because their institution advertises a zero-liability pledge on their card. You must understand that a bank's internal zero-liability card policy is merely a voluntary promise, not a statutory federal protection. The safeguards provided by the Fair Credit Billing Act on credit accounts represent actual federal law enacted by lawmakers. A financial institution cannot rewrite federal statutes during a corporate board meeting, but they can alter their own internal rules whenever they please. Banks have historically narrowed, restricted, and conditioned these voluntary programs when fraud spikes, and they will do so again. Relying on a company memo rather than congressional law leaves you vulnerable to sudden policy shifts. There remain exactly 4 specific scenarios where using your debit card is still the right tool, and it helps to be highly precise about them because the objective is not to abandon the card entirely, but to limit its exposure to safe zones. The first is obtaining cash from an automated teller machine located directly at your own financial institution. In this scenario, you are pulling out physical cash rather than submitting your card credentials to an external merchant database. Remember to block the view of the buttons with your hand while inputting your PIN, and dedicate 2 seconds to verifying that the card entry point is firmly attached. Authentic bank machines feature readers that are solidly embedded into the frame, so if a piece shifts or feels unstable when touched, simply walk away to find an alternative machine or step inside the lobby. While ATM skimming risks are real, they are entirely manageable with a moment of caution. Small, independent businesses that do not accommodate credit transactions represent the second acceptable exception, provided you only spend the absolute minimum required for that specific purchase using your secondary account card rather than your primary income account. The third exception involves public agencies or utility providers that impose a processing fee between 2.5 to 3% for credit card payments. On a typical $200 utility statement, a 3% charge adds an unnecessary $6 to your expenses. So if utilizing your debit card allows you to clear the balance without a fee, it makes financial sense to do so using your secondary account card. Finally, any enterprise offering a direct discount for cash or debit transactions fits the same rule, provided you strictly use your low-balance secondary card. To keep your active cards secure, you should implement a specific safety checklist immediately. First, configure real-time transaction notifications for every single instance your card is used, avoiding daily or weekly summaries entirely. You want a text message sent to your phone the very moment a charge occurs for any monetary value, allowing you to recognize unauthorized activity within minutes rather than days. Contact your provider today to confirm this feature is active, and if it is not, request that they enable it before ending the call. Second, adjust your daily spending threshold significantly below the institution's standard settings. Most institutions automatically set these daily limits between $500 to $1,000, but you should request to drop yours down to $200 or $300. This modification will not stop you from making larger, pre-planned purchases, since a quick phone call can temporarily raise it, but it absolutely prevents an out-of-state thief from running up $900 across multiple retailers before the sun comes up. Third, never save your card details inside digital shopping profiles. If that merchant experiences a data breach, your primary checking account becomes the target, so take the time to type the numbers manually each time, or inquire if your institution provides temporary virtual card numbers. Fourth, audit your transaction history every 3 to 4 days rather than once a month. The 60-day protection window outlined in the Electronic Fund Transfer Act offers very little room for error, and uncovering a fraudulent charge by week 7 pushes you into a bracket where your personal legal liability grows exponentially. Spending just 3 minutes twice a week to log in and review the last 10 entries allows you to spot anything unfamiliar and report it instantly. Finally, establish an unyielding rule for when you pull up to get fuel. Never insert a debit card directly at a gas pump. Either step inside to pay the attendant at the counter or use a credit card at the station island. Fuel pump skimmers represent an incredibly large percentage of all the debit card fraud reports submitted to the FTC annually. These areas remain unmonitored for hours, and current skimming devices are tiny enough to be hidden entirely within the pump's internal housing, where a simple glance from the outside cannot detect them. Opting for a credit card at the pump incurs no extra fees and permanently shields your actual bank account from the highest risk transaction spot in your normal routine. Looking at the entire landscape, your standard debit card operates under a completely different and far less protective framework of federal law compared to a credit card. If you fall victim to a scam, your actual household funds can be frozen for up to 10 business days, while your recurring bills continue to bounce and heavy penalties pile up. Your institution's zero-liability policy is merely a voluntary internal rule that can be modified at any moment without warning. Splitting your finances into a 2-account system takes just a single phone call and permanently isolates your primary retirement income from public terminal dangers. There are only 4 specific instances where utilizing a debit card remains logical: extracting funds at your bank's own automated machine, patronizing cash-only merchants, paying utility or government fees to avoid a convenience charge, or capturing a specific debit discount. Restrict your usage to those precise moments and substitute a credit card or a low-balance secondary account for everything else. Please pass these insights along to at least one person in your life who is currently routing their monthly Social Security checks and daily purchases through the exact same card. Sharing this perspective could easily protect their $2,071 benefit next month, saving them from 10 days of grueling calls to utility and mortgage companies while an unexpected investigation unfolds.